All right.
Okay, friends. So I'll now take a fresh one and we'll call this as MTP part 1. I think last time we had done part 2, correct? Friends, MTP part 1 is relatively easier than MTP part 2. All right. So what we'll do is we'll start off here now. Okay. So now what we are going to do is question number 1 is slightly tricky. So let's do that in the end. Let's go from question number 1B onwards. Okay. So let us take question number 1B. So I'll write down over here question 1B. Friends, 1B, we'll do it as per your study material, but there is a mistake in the way your study material does it. I will explain what is the mistake also, but exam point of view, you please follow that same approach because ultimately what we need here is that we need to get marks in the examination, correct? So question number 1B. The RF is how much percentage? 8%. So I'll write down RF is equal to 8%, and the expected rate of return of the market is how much? RM turns out to be 12%. The expected rate of growth for dividend is turning out to be how much? 6%. So the growth is given as 6%. The last paid dividend on stock is 5. So is that D1 or D0? It will be D0. Friends, keep on talking along with me, okay? Even though I cannot hear you, please keep on talking, all right? D0. And the beta is given as how much? E. The beta is given as, I think, 1.5. All right. From this, they are asking you to find out the equilibrium price. That part is very much easy. So I'll just write down below this working note number 2, analysis. Okay. So here, I think we can find out the CAPM return or KE, that is equal to RF plus beta into RM minus RF. So can you tell me how much is the CAPM return that you get over here? One moment. I have muted all of you. Okay. Yes. Do you get the answer as 14% over here, friends? All right. So once you get the CAPM written as 14%, working note number 3, I will write down what will be your equilibrium price. Okay. So the formula P0 will be equal to D1 divided by KE minus G. So that will be 5 plus 6% divided by 14 minus 6%. So what's the answer you get over here? Do you get the answer as 66.25? All right, I'll give you a minute. Please write down till here in your books. Done, friends. Can I go to the next part now? All right. Next part is slightly tricky. They have told inflation premium increases by how much percentage? 2%. So I'll write down working note number 4, revised scenario. Okay, in that they have told what is point number 1? Inflation increases by how much percentage? Have they told it to be 2%? Am I right? All right. 1 minute. Here, how much is the RM that is told over here? 8. All right. So next part. 1 that is given. Second, they have told the growth rate will increase by how much percentage? Growth will increase by 2%. So friends, from this, what they have done is they have found out your revised RF. How they have found out your revised RF is right now it is 8, correct? Plus 2% of 8. Can you do this and tell me what is the answer that you get over here? Do you get the answer as 8.16 percentage? That is point number one, what they have done. All right. Second thing, they have talked about growth. How much will be the revised growth now? Earlier, the growth was 6%, correct? Now, absolute terms plus 2 means it will turn out to be how much? 8 percentage. That part is clear. But this part is actually incorrect. I will tell you why this is incorrect. All right. Because, friends, if you remember what I have taught you in the chapter of international capital budgeting, we have learned that in order to add inflation, we have an equation 1 plus MDR is equal to 1 plus RDR into 1 plus IR. So, ideally, when you do like this, what I should do, I should take 1 plus 8 percentage as the RF multiplied by multiplied by 1 into 1 plus 2%. So ideally, when you do like this, you get a different answer. What answer will you get? Can you tell me? You'll actually get the revised RF as how much? It should turn out to be 10.16%. This is the actual answer. Okay. But this is the answer by ICAI. So we will follow only this. All right. This part just for your understanding. Are you all clear now, friends? All right. So now once you get this, remaining part is easy, friends. So from this, I'll write down working note number 5, revised CAPM. What will be the equation? 8.16 plus beta into RM. How much is the RM that they have told over here? Market return was 12 percentage minus 8.16 percentage. Can you tell me when you do like this, what is the answer you get? Beta is going up, is it? How much is the beta they have told over here? Beta is 1.8, is it? Okay, so here it will be into 1.8. So what's the answer you get? Do you get the answer as 15.07 percentage? Correct? Finally, from this, I can find out the revised price. So what will be the revised price? P0 is equal to D1. Now, D1 will be 5 plus 8% divided by KE minus G. So what's the answer you get over here? Do you get the answer as 76.38 rupees? We are done with this question. I'll give you a minute. Can you scribble down this in your books? I'll just get some water and come back. All right, friends. Are you all clear with this part? Can I go to the next question now? All right. So I think we are done with the first question. Let us go to the second question now. All right. That is question number 2A. It's a question on EVA. So I'll write down question 2A. Working note number 1. basic data. 1 minute. Yeah, Shebin, in textbook they have done it by just adding 2%. That is also incorrect. Okay, ideally you should just add plus 1.02 to the first one. RN is market return. Ideally, market return will consider inflation. We don't need to add inflation again. All right. Yes. So I'm going to the next question now. So here, friends, you have the revenue, cost, selling expense, EBIT is given, EAT is also given. So this is basically the P&L and this is the balance sheet. What is the formula for EVA? Formula is NOPAT minus whatever is the investment, that is the opening capital, okay, or opening capital into WACC. That is the formula for EVA. So here you tell me they have given this 615. That is actually EBIT before tax, correct? So how do you find out NOPAT? NOPAT will be EBIT into 1 minus tax. So that will be 615 into how much percentage? 70 percentage. So now tell me what's the answer you get. Do you get the answer as 430.50? Correct. Now, what about the investment? Ideally, the investment is supposed to be your opening capital, that is your equity, reserves, and non-current borrowings, because you're talking from both equity and debt perspective. So I'll write down opening capital employed. I believe this is the opening capital, all right, because they have not given any other information. 1050 plus 150 plus 150. So do I get the answer as 1350? Correct? Let me come down. Assume there is a bad debt provision of 30 lakhs is included in the SGA. That is, okay, over here they have a bad debt provision of 30 lakhs. And the same amount is reduced from the trade receivables. Interesting. So basically, they are trying to make the question a little bit more interesting by adding these adjustments over here. So friends, what are we going to do? If that is the case, this 30 lakhs being a provision, we will add back over here. All right. So once you add that back over here, what will be the answer that you will get? Do you get the answer as 460.50? Correct? And even to opening capital employed, it will get added to the assets. So your equity plus reserves will go up. That goes up, your equity reserves will also go up. So do you get the answer as 1380 over there? Okay. So once you get this, next we have to find out the WACC. So I'll write down working note number 2, WACC. So I'll just come down and just check. Pre-tax cost of debt is given as 12%. Should I take pre-tax or post-tax? We should take after tax always. Okay. So that will be 12 into 0.7. How much is that turning out to be? Do you get the answer as 8.40%? Correct. And equity shareholders KE is given as 10%. So KE will be taken as 10%. Now we need to take the weight of equity and weight of debt. In order to take the weight of equity, here non-current borrowings is lying at 150. All right. Whereas current equity and reserves is how much? 1200 is going to be your equity and reserve. So one moment, friends. One doubt will come here. Bad debts, when you add back 30, ideally your current assets go up. And your reserves also ideally should go up. But your textbook hasn't considered that while calculating the weights. Ideally, we should consider that part also. So weight of equity will turn out to be 1200 divided by 1350, and weight of debt would be 150 divided by 1350. So do you get the answer as 88.88%? And here, do you get the answer as 11.11% as your weight, friends? All right. So now from this, can you find out the WACC? 10 into 0.888 plus 11.1, sorry, 8.4 into 8.4 into what? 0.1 1, 1, 1, 1. Can someone tell me what is the WACC that you get over here? Do you get the answer as 9.82%? All right. So once you get this, I'll write down the next working note. That is the EVA. So the formula is NOPAT minus opening capital employed into WACC. So how much is your NOPAT? 460.5, 1380. 80 into 9.82%. So now tell me what's the answer you get over here. Do you get the answer as 324.98 lakhs? Am I right? All right, let me just confirm if that is the same answer. Yes, that is the same answer. So is your EVA positive or negative? Positive. So EVA should be accepted. I'll give you a minute's time. First, you write down this. Then just scribble and write. I'll share the notes immediately once the class gets over with all of you. Okay? Fine, friends. Padmapriya, you have a doubt? Yes,
Yes,
Padmapriya, please tell me.
sir, why that bad
Can you
debt
hear
provision
me?
is being? Yes, sir, I could hear you, sir. Sir,
1 minute,
sir,
I'm not. Yeah, tell me. Yeah.
yes, sir. Sir, why that bad debt provision of 30 lakhs is being added here and there, sir? Can you please explain it again,
I
sir?
will explain to you because NOPAT means when
Hmm.
you calculate EVA, it is actually more relevant in the concept of SCMPE chapter, okay? Subject.
Oh,
In that,
okay,
they have
sir.
very
Okay,
clearly
sir.
told when you do
Oh,
EVA, we take
hmm.
only the cash expenses. We don't take the non-cash expense.
Okay, sir.
So
Okay.
bad debt provisioning is a non-cash item. Am I
Yes,
right? So when you adjust back the bad debts provision, what is the entry that you pass? Bad debt provision account debit to sundry debtors, correct?
yes, sir.
So debtors will also go up, bad debts will also come down. Am I
Will
right?
come down. Yes, sir.
Correct. So if
Yes.
you reverse this, so that adjustment is what we have done over here.
Understood, sir. Thank you, sir.
Got it?
Thank you so much, sir.
Thank you so much. In fact, in SCMPE, I think it
Yes,
is
sir.
study material question number 2 or 3. One beautiful question is there on all this provisioning. They have done it very well. So
Okay.
once you do SCMP, do that question, that will clear all your doubts about this. Yes,
Yes,
tell
sir.
me. Done, right? Okay.
It's done, sir. Thank you, sir.
Thank you. Okay. So I believe you are all done with this question. Can I go to the next question now? All right. Let me go to the next one. So EVA done. Now we will do a question on futures. Question number 2B. Working note number 1. Basic data. Point number A. Calculate the justified price of 3 months futures. So what is the duration they have told over here? This is going to be 3 months. All right. If the share price of ABC is quoted at 450, so the MPS or P0 today is how much? 450. What is the face value they have told over here? 10 rupees is the face value. All right. And 1 month borrowing rate. I think they have given us 12% per annum. It's always per annum, friends. Interest is supposed to be always per annum. And the expected annual dividend is 20%. the dividend yield per annum is 20% per annum. Also demonstrate if there's any arbitrage after 3 months. All right. So basically they want you to find out the theoretical future price. So working note number 2, I will write down theoretical future price. Okay. We know the formula for theoretical future price. Can you tell me what is the formula? S0 into e raised to r minus y into t. So that will be 450 into e raised to. Now here is the confusion. Have they told the dividend percentage is given? It can be taken as dividend rate also. It can be taken as dividend yield also. Are you getting my point? So now that is where the confusion is. They can do it in both the ways because the question is actually silent. So first we will do it assuming it is dividend yield. Then I will show you doing it assuming it is dividend rate. Are you clear with that part? So if it is dividend yield, the equation will turn out to be R. The rate of return over here is turning out to be 12 minus 20% is yield. Okay, into 3 by 12. So I'll get the answer as 450 into e raised to 8 into 3 by 12. What is 8 into 3 by 12? 2%. E raised to minus 0.02. So it becomes a present value rather than a future value. Everybody clear? So first let's find out e raised to 0.02. That will be 1.02 plus 0.02 square divided by 2. So that will be 1.0202. Therefore, e raised to minus 0.02 will be 1 divided by 1.0202 into, that will be 0.9801, 0.9801. So F0 in this case will be 450 into 0.9801. You will get the answer as 441. All right. So this is done with one assumption that the dividend percentage is dividend yield. Okay. Assuming 20% as dividend yield. Now I will give you an alternative answer. Okay, wait, just scribble down till here. I'll give you a minute's time. All right. So friends, this is one way of doing it. Okay. Now, I'll just come down a little bit. All right. Now the next one, I'll write down working note number 3. Okay. Future rate assuming 20% is dividend rate. Okay. Then the formula would be F0 is equal to S0 into e raised to RT minus D into e raised to RT. So F0 will be equal to 420 into e raised to R. Now the rate is 12% into 3 by 12. Correct? Plus, how much is the dividend if it is a rate? If it's a rate, then it is 20% on 10 rupees. Can I say that is 2 rupees? It is not plus, it is minus. Minus 2 rupees. Now, when have they received the 2 rupees? Again, not given. So we can assume it to be received either at the beginning of 3 months or at the end of 3 months or in between. What assumption do you want to take? Do you want to take at the beginning or at the end? End. All right. So into 2, we'll just give a note over here. Assume it is received at the end of. So if you do at the end of 3 months, compounding is not required. All right. So 0.12 into 3 by 12 will be 0.03. So that will be 450 into 1.03045 minus 2 rupees. You get the answer as 461.7025. And I think that's the same answer in your textbook also. Textbook, one mistake that they have done is they have used simple compounding. Ideally, we are supposed to use continuous compounding. Can you write down this now? All right, friends. I believe you're all done with this part. Okay. Can I go to the next one now? All right. One moment. All right. So once you get this, I'll go to the next working note and I'll write down arbitrage. So here they have told the price after 3 months is how much? 470. So I'll write down point number A, actual future price. How much is that? 470. Point number B, theoretical price. What is the theoretical price that we got right now? 461.7. So tell me, is the actual price overvalued or undervalued? It is overvalued. So are you supposed to buy future or sell future? You are supposed to sell futures. Okay, I believe you're all done, right? Just scribble down this. So we are done with this question. We can go to the next one. Yes, Sarvamangala, please tell me.
Good evening, sir.
Good evening, Sarvamangala. Please tell me.
So in this case, we had taken both two assumptions, right, for calculating theoretical future price.
Correct.
So actually, for both, the actual future price is overvalued if we consider either of the options.
Exactly. Yes.
But suppose we had to choose one of these two, then if there was one was a higher amount compared to the actual,
Okay.
and the other
No,
theoretical
that's
price
the
is
solve it basing one of the assumptions. You know, you cannot take both the assumptions. I've given you two because I just wanted you to understand that this is how the answer can also come.
right. Okay, sir.
All right. Exam, you do it using only one method. Any one is okay.
Sure, sir. Okay.
All right. Okay.
Thank you, sir.
Thank you. So I believe everybody is done writing this, friends. Fine. Can I go to the next one now? Wait, now let's just check. Also demonstrate if there is any arbitrage. So we've got the answer as sell future. Now let us give you a proof. I think that's what they mean by demonstration. So I'll write down the next working note, proof. All right. So what is the answer we got? Are we going to buy future or are we going to sell future? We are going to sell future. So there are two markets are there. First one is a spot market. And the other one is a future market. So what they are trying to tell you here is that you buy in the spot market at the spot price. What is the spot price today? Do you get the spot price as 450? Correct. So in order to buy this, you don't have money with you. So you're going to borrow at the rate of 12%. So now tell me how much will be 12% for 3 months? Do you get the interest amount as 13.5 rupees? Correct. So now at the end of the period, how much money you have to pay over here? You have to pay 463.50 rupees. All right. Whereas what are you going to do in the future market? You are going to sell future. All right. You're going to sell at what price? What is the actual price over there right now? 470 rupees. All right. So once you sell at 470 on expiry, okay. Now what happens is here they are giving you a dividend. How much dividend are they paying you? 2 rupees. So this will be reduced. What will be the net price that you get over here? Net selling price that you have over here, it will turn out to be 468. All right. So that is going to be your final price. So at the end, whatever be the S1, this is, let me call it as S0. And this one is your adjusted F0. Now let us assume your actual price or at the end of the period is turning out to be, tell me some number. Shall we take 500? Suppose you're selling at 500 rupees. Here you'll sell at 500. Here you're going to buy at what price? 500 rupees, correct? So 463.5 minus 500. Here you make a gain of 36.5. Whereas here 500 minus 468, you make a loss of how much? 32. Okay. So now when you net up these two things, you will get the net gain as how much? 4.5. Hence proven that you are always going to make a profit. Now, if you have a doubt with 500, you put 400 over there. Even then, you will get the same profit of 4.5. I'll give you a minute's time. Can you scribble down this and finish it off? Perfect, friends. I believe you're all done with this. George, the solution is different, is it? 1 minute. They've got a gain of dividend is added. Hold on. Dividend becomes my inflow. Okay, wait. I think what I'll do is, I think I got your point. Dividend wouldn't come in the futures. Sorry. It should be reduced over here in the payable part. Sorry, friends. Thank you for correcting me, George. 1 moment. So here it will be less dividend because I'll receive that money, right? So I'll pay it from there. Net will become 461.5. And here I believe it will remain at 470. Okay, so now what happens? You will have 500, so you make a loss of 30. Here you end up, 1 minute. Here you're going to, it will be 461.5. Then you sell at 500, correct? So your gain over here will be 39.5, correct? 500, sorry, 38.5. 1 moment. 38.5. So your net gain will turn out to be 8.5, correct? Sorry, friends, I added that in the wrong place. Thank you, George, for correcting me there. Net will be 8.5, correct? Please write down now and finish it off. Fine, friends. I believe you're all done with this part. Okay, can I go to the next one now? Right. So we are done with this question also. Okay. Now next one is bundling and unbundling, a theory question which I have covered in my theory marathon. I'm not doing that here now. Question number 3A. Friends, this type of question we have done in RTP also, MTP part 1 also, Super 25 also. All right. So let us do this one question also. I think exactly same question we have done it before. Am I right, friends? You might not be remembering. So let's do it now. Question number 3A. We have done the exact question. Let's quickly do and wrap it up. Face value is given as 250. This question was done earlier, but let's just do it for practice sake. Coupon rate is how much? Coupon rate is 12%. Number of shares per bond. So shares per bond will be 20 shares per bond. All right. Then you have MPS. What is the market price per share that you have over here? Is it 12? Okay, next one. Straight value of the bond. Straight value of the bond is 235. That is present value of future cash flows. So the market price of the convertible bond is how much? 265. So once we write up all these things, I will write down working note number 2, analysis. All right. There are different terminologies. First, they are asking you the stock value of the bond. So what do you mean by the word stock value of the bond? What is the market price of one share? 20 rupees, sorry, 12 rupees per share. Into how many bonds can we convert into 20 bonds? So do you get the answer as 240 rupees? This is what we call it as the stock value of the bond. In other words, we can also call it as a market conversion price. Okay. So what do you mean by market conversion price? That will be 265 is the price of one bond. If I convert that into 20, 20 shares, ideally the price per share should be how much? 13.25. But right now, what is the price of a share? 12. What is the difference? 1.25. This 1.25 has to be given by way of premium. So I'll write down over here conversion premium. All right, so that will be 13.25 minus 12. You will get the answer as 1.25. This on 13.25 will give you the premium in percentage as how much? 9.43% will be the percentage of premium that will come up over here. I believe everybody is clear so far. 1 minute. From 13.25, it has to fall down, or from 12, it is going up. 1 minute. Sorry, it should be divided by 12, not by 13.25. Because from 12, it has to go up, correct? So the premium will be given on 12. So can you tell me how much is 1.25 divided by 12? Do you get the answer as 10.41%? All right, I'll give you a minute's time. Please scribble down till here in your books. All right, friends. I believe you're all done with this part. Let's go and check what are they asking over here. Stock value of the bond done. Percentage of downside risk, we have to do it. Conversion premium is what we have already got over here. It's not conversion price, it is conversion premium. Okay. Then what are they asking? Conversion parity price. This market price is also called as conversion parity price. So only one more thing we have to find out, percentage of downside risk. So I'll write down over here percentage of downside risk. So friend, how do we do the percentage of downside risk is how much is the market price as of now? 265. What is the straight value of the bond? Is it 235? So what is the chance of the fall that is can happen over here? 30. So this fall, if you want to find out in percentage, that will be 30 divided by 265. That is 11.32 percentage. This is what they call it as percentage of downside risk. Okay. Please write down this. I believe you are all done with this part. Can I go to the next one now? Okay, so we are done with question 3A. Let us do question 3B, which is a very simple question on mutual funds. All right. I will write down working note number 1, basic data. Mr. A is having how many units? 500 units. I'll write down units that we have is 500 units, which has shown its per unit NAV as how much? NAV 0 is how much? 9.75 and 12.35. So NAV 1 is equal to 12.35. Okay. The mutual fund has given two options. Receive a payment of, so we need to analyze these options separately. So I'll write down working note number 2, option 1. So what happens in option 1 is they receive a dividend of 1.25 as dividend and zero point 0.8 as capital gain. So let us do that. What is the formula for actual return of a mutual fund? NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0. So NAV1 will be how much? 12.35 minus 9.75 plus D1 turns out to be how much? 1.25 plus CG1 turns out to be how much? 0.80 whole divided by what? 9.75. Do you get the answer as 47.69 percentage? Perfect. Can you scribble down till here in your books? Fine, friends. Can I go to the next part now? Are you all done with this? Perfect. Now let's read the second part of the question. There they say that these distributions are reinvested at an NAV of how much? 11.05. So I'll write down option number 2. So here I'll write down NAV1. How much is NAV1 that we have? Okay, we need to work out that. What we'll do is first, we will take the total D1. Total D1. How much is the D1 they have told over here? Is it 1.25? So it is going to be 1.25 into how many units? 500 units. Okay. Next one is what? Total CG1. How much is going to be next to CG1? 0.8 into 500 units. All right. So I'll give 1.25 into 500. That is equal to 625. Next one turns out to be how much? 400. Okay. So you get the total as how much? Total will be 1025. Everybody clear with this part? So this will be reinvested at what NAV? Can you all tell me? 11.05. Okay. So you get the units. Units reinvested. That will be 1025 divided by 11.05. Do you get the answer as 92.76 units? Okay. Therefore, what will be your closing NAV? That will be 592.76 units into the closing NAV. What is the closing NAV? 12.35. So what is the answer you get over here? 592.76 into 12.35. Do you get the answer as 7320.58 rupees? Am I right? Okay. Next one. What is going to be the next one? Opening NAV. What will be the opening NAV? 500 units into 9.75. So what is 500 into 9.75? 4875. So now tell me from this, what will be the return that you're going to find out? NAV1 minus NAV0 plus D1 plus CG1 will become 0 now. Into this multiplied by what is the duration they have told? That's not given. So let's ignore that part for time being. So 7320.58 minus 4875 divided by 4875. Do you get the answer as 50.16% over here? So tell me, friends, which one is better? Is option 1 better or option 2 better? Option 2 is better. Perfect. Please write down and finish it off, friends. All right, friends. I believe we are all done with this. Can I go to the next one? Okay. Next question, 4A. Friends, 4A is exactly the same question that we have done in my regular class, in my 110-hour marathon. And I believe we did the same thing for our Super 25 also. It is a question on real cash flow, and money cash flow also. We have done exactly the same thing. Should we do this now, friends, or can I go to the next one? I've done this in almost all the sessions. I have not missed this question anywhere. Any of the marathons where I have not done that? And if I'm not wrong, even in the RTP earlier session, it was there, right? The same question was there. I think it was just instead of African rand, it was Nepalese currency. Am I right? We have done the same thing multiple times, friends. For time being, I'll keep it pending. Let's finish the other questions, okay? Because repeatedly doing the same thing will be of no use. Okay, you can just brush through it yourself and do it. All right. Yes, let's go to this question. Even this was done somewhere, but this is slightly different. We can, do this together now. All right. So let's do this. What is the question number? Question number 4B. 4B. All right. Question number 4B. So here they have given you that a mutual fund is having 5 lakh units of 10 rupees each. No entry load was charged. Okay. So I'll just start off with there is an opening cash of 5 lakh into 10 is 50 lakhs. From that, they have invested 40 lakhs over here, 4 lakhs in the government security, 2.5 in debenture and 2.5 in debenture again, and 49 lakhs. So what will be your closing cash balance over here? That will turn out to be 1 lakh. Okay. Apart from this, during the year, they have a dividends of how much was received on equity share, 6 lakhs. So let us write down working note number 1, basic data. Point number A, initial capital. What is the initial capital that is introduced? 50 lakhs. All right. From this, point number B, invested amount. So what is the invested amount that you have over there? Do you have 49 lakhs? So from this, can I get the balance of cash that you have right now? Do you get the answer as 1 lakh as the balance cash? Correct? Now, after this down, they have told dividends of 6 lakhs was received. That will again add to the cash. So add dividend. How much is the dividend that they are having? 6 lakhs is the dividend. All right. Next part. Interest on all type of debt securities was received as and when due. So on 4 lakh rupees, 7% they have got 28,000. So interest on government securities. Interest on government securities. Will that turn out to be 28,000? All right. Point number F, 2,50,000 into 9%. That is 22,500. Interest on unlisted debenture. How much is that? 22,500. Okay. EFG. 10% debentures listed. So interest on listed debenture. That will be 2,50,000 to 10% will be 25,000. Everybody clear? Then what next have they told? At the end of the year, 10% debentures. Okay, that part we'll come to it later. Cash wise, let me see. And find out if the operating expense is 2,50,000. So now what are we supposed to do? Reduce the OPEX or operating expense, that is 2,50,000. Not only this mutual fund has distributed dividend of how much? 0.8 per unit. So less dividend. How much is the dividend they are telling? 0.8 into 5 lakh units, correct? Do you get the answer as 4 lakhs? So once you reduce this, what is the answer? You get 1 plus 6 plus 28,000 plus 22,500 plus 25,000 minus 2.5 minus 4. So do you get the answer as 1,25,500? Hold on, there's a mistake. Did I leave out anything? 1 lakh we have taken, 6, 28, 22,500. 25,000 also taken, minus 2.5. Dividend, is it payable? They haven't considered dividend in the solution. 1 minute. 1 minute. Haven't they told the dividend of 0.8 Also find the NAV if, okay, that's a situation number 2 is what I understand. Okay. So situation 1, they don't have dividend. Situation 2, they have dividend. So let's keep it away for time being. Okay. We'll add it up later on. So if I remove this, what is the cash balance I'll get? Is it 5,25,500? I'll give you a minute's time. Please scribble down this. All right, friends. I believe you're all done with this part. Can I go to the next one? Okay. So once you are done with the first part, now they have told we'll just find out the NAV. So working note number 2, NAV. Point number A will be what? Cash. What is the cash balance that you have? 5,25,500. Correct. Point number B, they have told at the end of the year, equity shares were quoted at 175%. 175%. So it is 25,000 equity shares was there of 100 rupees each at 160. But now they are saying that was quoted at 175 rupees. So equity shares will be 25,000 shares into 175 rupees. Do you get the answer as 43,75,000? Correct. What next have they told? 10% debentures were quoted at 90%. 10% debentures. 2,50,000 were quoted at 2,25,000. Okay. Then other investments were valued at par. So 7% government securities, what it was at 4 lakh? Was at 4 lakh. And what is the other one that we have? 9% will be again 2,50,000. All right. From this, can I get the total assets? That will be 5,25,500 plus 43,75,000 plus 2,25,000 plus 4 lakh plus 2.5. Do you get the answer as 57,75,500 divided by how many units? 5 lakh units. Do you get the answer as 11.551 rupees per unit? Perfect. And here itself I'll write down if dividends are declared. If dividend is declared, it will be 11.551 minus 0.8. So then what is the answer you will get? You get the answer as 10.751 rupees per unit. So we are done with this question also. So I believe you're all done with this. Perfect. Can I go to the next question now? So we are done with 4B also. 5A. Friends, this is again exactly the same question that I have done in my regular class and all my marathon sessions. Do you remember? 10.5 is given, 31.5 is given, aggressive, defensive. And then they're asking you to find out the beta of two securities, expected return, security market line, and alpha. I'll do this quickly, okay? Because we can solve it faster. Otherwise, I'll have to skip many questions of this MTP. Many are from our material itself. So working note number 1, we will write down beta. Okay. Point number A, they have given aggressive and defensive. I will do only for aggressive. Okay. Defensive will be exactly the same. So how do you find out the beta in this case? It will be change in security return divided by change in the market return. That's the easy formula that we can use. So it will be 60 minus 6 divided by 37.5 minus 10.5. So what is the answer that you get over here? Do you get 54 divided by 27? Do I get the beta as 2 over here? Correct? All right. Expected return. So now they're asking you to find out the expected return. All right. First, I'll find out the expected return of the market. How do you find out the expected return? Outcome into probability. So that will be 10.5 into 0.5 plus 37.5 into 0.5. All right. So now tell me. Do you get the answer as 24%? What about aggressive security the same way? It will be 60 into 0.5 plus 6 into 0.5. So do you get the answer as 33%? Correct? Then they are asking you to find out the security market line. Friends, security market line is nothing but graphical representation of CAPM. So here it will be 11.25 plus beta will be kept as variable into RM minus RF. So RM is how much? 24 minus 11.75. This equation is what we call it as the security. This equation is called as the SML equation. Okay. Now the last thing what they're asking you to find out is the alpha. What is the formula for alpha? Expected return minus required return. So the expected return, we already have got the answer as 33% minus required return will be 11.25 plus 2 into 24 minus 11.75. 35.75 minus 33. We get the answer as minus 2.75. Alpha is negative. Should you buy or should you sell? You are supposed to sell. Can you write down this and finish it off, friends? All right, friends. Are you all done writing this? Fine. I'll just go to the next page. All right, friends. Are you all done with this? Okay. George, you're there online, right? You had a doubt. I couldn't understand it fully from the message. Can we discuss it over here after the MTP session gets over? Can you just raise your hands in the end? Please type a yes if you are available live. All right. So I believe we are all done writing this. Sarvamangala, you have a doubt? 1 minute. Yes, Sarvamangala, please tell me.
So in SML equation, so
Yes, tell
that
me.
is nothing but RF plus beta into RM minus RF, right?
Which one?
SML equation.
Yeah, that is the same equation. Only one thing what we do is we keep the beta as a variable.
Yes, sir.
Correct.
So our RF is 11.25.
Correct.
In RM minus RF that we're doing, we're taking 11.75, right? So
Oh, that's a typing mistake. So sorry, it's 11.25.
okay.
Thank you for correcting me. Just it came off quickly. Okay. Right. All right, friends. So I believe you're all done with this. Can I go to the next question now? Okay, so 5A is done. 5B is a very, very simple question. Shall we do this now? It's a question on cap. So I'll write down question 5B. This is straight taken from your study material. Working note number 1. This is done in my regular class, not done in my 110-hour marathon. Okay, a textile manufacturer had taken a floating interest rate loan of 40 lakh. Okay, on 1st April 2012. The rate of interest at the inception of loan is 8.5%. 8.5% to be paid every year on 31st March. All right. And the duration of loan is 4 years. In the month of October, they release the following projections. So 8.75, 10, 10.5, 7.75. Advise the borrower how he can hedge the risk arising out of the expected rise in the rate of interest when he is interested in pegging his interest cost at 8.5%. So borrower wants to peg his interest rate at how much percentage? At the rate of 8.5%. If option on interest rate is available at 0.75, so that is the premium. All right. So once you pay the premium, what will you do in order to peg the interest rate? Will you buy a cap or will you buy a floor? In order to peg the interest rate, borrower has to buy a cap. Borrower has to buy a cap at the rate of how much percentage, friends? At the rate of 8.5%. So the premium will go from his hand. Assume that the premium negotiated by both the parties at the above mentioned rate, which is to be paid on upfront basis, and the actual interest rate turns out to be as follows. All right, so these are the actual rates. So we need to go and find out the calculation. So I'll write down working note number 2, payoff table. Okay, so in this I'll put the dates first. First column will be date. So what are the dates? They are called 31/3/2013. Then you will have 31/3/2014. 31/3/2015, and the last one is going to be 31/3/2016. What is the interest rate that is told over here? 10.2, 11.5, 9.25, 8.25. What is the cap rate that they have told over here? 8.5. Okay. If this is the case, in the first case, 10.2 is the rate. He has to pay only 8.5. His gain will turn out to be 1.7%. All right. What is the total amount of borrowing that he has done? 40 lakhs. We don't need to actually consider that. We'll just do it in percentage basis. 11.5 minus 8.5 will be how much? 3%, 0.75%. In last case, there is no gain. I'll take the gain as 0%. And what is the premium that he has to pay? 0.75%. Am I right? What is the premium they have told in the question? 0.75%. Once you do this, what will be your net gain or your loss? Can we find out? Here you will make a gain of 0.95%, 2.25%, 0%, minus 0.75%. Can you scribble down this and finish it off? Let me see if they have taken the total value or no. Ideally, percentage is enough. They have done it in percentage only. All right, friends. Are you all done writing this? Okay, so we are done with this question also. Next is a question on pitch presentation. Again, that's covered in my theory marathon, friends. If you go through that, this PPT is fully covered. Okay. Next is a question on mergers. So we have question 6A, 6B. Two more questions, friends, and we'll be done with the MTP part 1 also. 6A is a basic question on mergers. We have done similar type question in class, but still I will do this. Okay. 6B is a beautiful question on London Frankfurt. This is done in my crash classes, but being a tough question, we will do this. Yes, question number 1A is also left. We will do that after we complete these two things. Okay. So let us write question number 6A. Working note number 1. Basic data. Particulars. You have M and R. Point number A. They have given the earnings after tax. So how much is the earnings that they have after tax? 4,000 lakhs and 8,000 lakhs. Point number B is going to be what number of shares? So how many shares are there? 400 lakhs and 2,000 lakh. From this, can I find out the EPS? Do you get the answer as 10 rupees per share? And here, do you get the answer as 4 rupees per share? PE ratio is given over here. What is the PE ratio? That's turning out to be 5 times. 2.50 times. From this, can I go and find out my MPS? So that will be 50 rupees per share. And here it is 10 rupees per share. From this, I can also find out what is going to be my market value before merger. That is 400 into 50. 20,000 lakhs and 2,000 lakhs. I'll give you a minute. Please scribble down. Fine, friends. I believe you're all done with this. Can I go to the next part now? All right. Yes. So once we are done with the basic information, let us read the question. What is the swap ratio based on market price? So working note number 2 will be swap ratio. Friends, based on market price means 50 rupees and 10 rupees. So what will be the swap ratio? It will be 1:5. Or what is the logic? For every 5 shares of, I think, M Limited will issue only 1 share. That is the logic. Then they are asking the EPS after merger. So working note number 3 will be what? EPS after merger. How do you find out the EPS after merger? Total earnings after merger, that is 4,000 plus 8,000, divided by number of shares after merger, that is going to be 400 lakh shares plus 2,000 into 1 divided by 5. So it will be 12,000 divided by, how much is 2,000 divided by 5? 400. So do you get the answer as 800 lakh shares? So do I get the answer as 15 rupees per share? Once I get this, can I automatically go and find out the MPS also after merger? That will be 15 rupees into the P ratio of the acquiring company. That is 5 times. So do you get the answer as 75 rupees per share over here? Correct? Let's just go and check what else are they asking. EPS we found. What is the expected market price per share assuming P ratio is adversely affected by 10%? So friends, there is a small change. If it is affected by 10% means 5 times will become how many times now? It will become 4.5 times. So what is 15 into 4.5 times? Do I get the answer as 67.5? Yes. 67.5 rupees per share. So we got swap ratio, we got the EPS, we got the MPS. Now we need to find out the market value of merged firm. How will you find out the market value of merged firm? 67.50 into how many shares are there now? 800 lakh shares. We'll get the answer as 54,000 lakh rupees. Okay, can you scribble down this in your books now? Yeah, Sarvamangala, they have told that the P ratio is adversely affected by 10%. Right now, the P ratio is 5 times. If it is adversely affected, it will be 5 minus 10%. That will give you 4.5 times. Are you clear now? All right. Just a minute. Please write down and finish it off. All right, friends. Now I'll go to the next part. Last part, they're asking the gain or loss due to merger. So, friends, gain or loss can be done either based on market value or based on earnings. Which is better? Based on market value. We will do it based on market value. Okay. Particulars. You have M and you have R. What is point number A? Market value after merger minus market value before merger, gain or loss. So here he is holding how many shares? As of now, he is holding 400 lakh shares into what is the MPS after merger? 67.5. Before merger, what was the MPS of this company? I think it was 50 rupees, correct? So the difference will be his gain. Whereas for R is also holding 400 after merger. Before merger, it was holding 2000. And what was the MPS before merger? 10 rupees. Correct? So here it will be 400 into 67.5, that is 27,000 lakh. Earlier was 20,000. Here also 27,000. Earlier was 20,000. Was it the same before merger? 1 minute. Yeah. It's 2,000, right? 1 minute, 1 minute. Yeah, correct. 2,000 shares. One moment. Basic data is incorrect, is it? Hold on, hold on. Okay. I made a mistake here. It's supposed to be 20,000 for both the cases, correct? All right. Thank you for correcting me there. So here also it will be 20,000. So what is the gain that you get over here? 7,000 lakhs and 7,000 lakhs. All right. Yes, please write down. And this scenario is what we call it as synergy. Yes. So we are done with this question. Also, two more questions to go. Fine, friends. I believe we are all done with this part. Okay. Can I go to the next question now? Let's do the final question, which is a tricky and a very, very good question. What's the question number? Question number 6B. Working note number 1. Basic data. London office is having a surplus funds of 10 lakhs. So it has got $10 lakh for a period of how many months? Duration is going to be 3 months. All right. The cost of fund to the bank is how much? 4%. Cost of fund is 4%. It proposes to invest these funds in London, New York, or Frankfurt, and the following rate of interest are available at the 3 centers. Okay, so what's the interest rate in London? 5, New York is 8, and Frankfurt is, so I'll just write down London 5%, New York is 8%, and Frankfurt turns out to be how much percentage? 3%. All right, fine. Okay, so now they have given the spot rate and the future rate. We'll consider that later on. First, understand the question till here. Fine, friends. Let's do it together now. So basically, they are having, George, that is the opportunity cost, George. That is the opportunity cost. That if I don't put my money here, I can put my money in US at least 4%. All right. So now I'll write down next to working note. Let us assume I'm going to invest in London. Okay. So point number A, surplus funds. Everyone tell me how much is the surplus funds available with me right now? I think it's 10 lakhs. So what will I do? If I'm in London, I have to convert this, correct? So I will give the 10 lakh dollar and the bank is going to buy. In return, bank is going to give me pound. Okay. So tell me, will it be the bid rate or ask rate? They've used the word London or New York. That is basically dollar per pound. So tell me, considering this dollar per pound rate, will it be a bid rate or will it be an ask rate? Come on, tell me. Ask. Why? Because you give dollar, in return you get pound. Bank is selling pound. So it will be the spot ask rate. Everyone tell me what is the spot ask rate in the question? 1.5390, correct? 5390 dollar per pound. All right. So from this, can I get the pound received by me today? Multiply or divide? I will divide. So do you get the answer as 6,49,772 pound? Correct. So once I get this, I will invest this at the rate of how much percentage? In London, it is how much percent? 5%. Correct. So 649,772 into 5% into how many months? I think 3 months, right? 3 months. Okay. So now tell me, what will be my closing balance over here? Do I get the answer as 657,895? All right. So once you get this number, now what I will do is I will reduce the opportunity cost that I would have got. And I'll find out the net gain over here. So I'll do the opportunity cost separately over here, friends. Now, how much is the dollar that is available with me? 10 lakh. On this, my opportunity cost is how much percentage? 4% for 3 months. That is another $10,000. That is for 3 months. All right. So what is the closing amount that I have? 10 lakh, 10,000. So ideally, this 10 lakh, 10,000 is what I would have given and the bank would have given me pound. Correct. So to this, I will use the 3 months forward ask rate. So tell me what is the 3 months forward ask rate given in the question? We have to add 85 if I'm not wrong. 5090. Okay, there are two interpretations to this. This can be taken as 1.53, 15, 18, 30, 35, 80. We'll add it up. 1.5390 plus 0.085. That will be 1.624. Let's check how your textbooks have done it. They have taken the above sum as 1.5430. That is the average rate they have taken. That's not correct. Hold on, friends. These are swap points, am I right? This is in ascend, descending, descending, descending. This is swap points. Okay. So 1.5390, 1.5390 plus 0.085. 1.6240. Correct. That's the rate. I will take the correct rate and do it. But they have done in your book using 1.5430. Why have they given that? Let me just come down. Due to a conservative outlook is what they are saying. That doesn't make sense. After 3 months only, we would have converted. So that would have been 1.6240 dollar per pound. So what is 10 lakh 10,000 divided by 1.6240? Do I get the answer as 6,21,921 pound? Yes, George, that is a 3 months forward ask rate. See how I have taken that, I'll explain to you. If you see over here, here you have 1.5390 is given, correct? To this, you will add 85 points. So 5390 plus 85 will give you, oh wait, it's 5475. Sorry, I've made a mistake there. It's 5475. Correct. I think that was a mistake. I don't know how I got that number. 1.5475. We get the number as 6,52,666 pound. All right. So that amount I'll take it over here, 652,666. So once I reduce this, what is the answer I'll get? 5,229 pound. I'll give you a minute's time. Write down and understand this part. All right, friends. I believe you are clear with this part. Can I go to the next one now? This was investing in London. Now I'll write down the next working note. Invest in New York. This is easy because what is a dollar available with you? 10 lakh. Correct? Now, what is the interest at the rate of in US? What is the interest that they're going to get if they invest over there? Is it 8%? So that will be 10 lakh into 8% into 3 divided by 12. Do you get the answer as $20,000? Okay. Total will be 10 lakh $20,000. Now from this, what are we going to do? We'll reduce our opportunity cost, which is actually turning out to be 10 lakh $10,000. That's what we found out over here, correct? So what is your net gain in dollar? Is that turning out to be $10,000? Correct. So now if you want to find out the gain in pound, you will convert this at 1.5475. That will be $10,000 divided by 1.5475. Do you get the answer as 6,462 pound? This is going to be your gain. Can you write down this now? All right, friends. I believe you're all done with this one also. So now next one, final one is what? Invest in, what is the third country that they had over here? Frankfurt, that is Euro. All right. Again, point number A. Surplus funds. How much is of surplus funds available? 10 lakh dollar. Now we need to go to Frankfurt and exchange this. So it's given London on Frankfurt. Friends, London on Frankfurt would be euro per pound. But do we have the euro per pound exchange rate over here? Sorry, do we have the euro per pound? Will not help us to convert 10 lakh dollar. I need to use the cross rate. So I'll write down point number B. Desired rate for me is euro per pound. This also we need ask because we will give euro and the bank is going to give pound ideally. Am I right? 1 minute. Let me confirm. I have 10 lakh dollar. So I need an exchange rate of euro per, hold on. No. Sorry. No. My desired rate is going to be either euro per dollar or dollar by euro. So what will I do? I will give the dollar. The bank is going to give me euro. Hence, it will be the ask rate. Correct. So in order to get this, I need to use the cross rate equation. What will be the cross rate equation? Ask dollar bar euro is equal to ask dollar bar pound into ask pound bar euro. So how much is ask dollar per pound? Spot ask dollar per pound is 1.5390 into pound per euro. They have given euro per pound. So I'll do 1 divided by bid. 1 divided by 1.8260. So what's the answer I'll get? Do I get the answer as $0.84 bar euro? I hope I've done it correctly, friends. One moment. They have given euro per pound. So ask. It's correct only, right? Okay. So once you get 0.84, because for euro is actually more powerful. I don't know how they got this 0.84. Let me confirm. I think that's correct. All right. So once you get this answer, so what will happen? Now I will do 10 lakh dollar divided by 0.84 dollar bar euro. I'll get the answer as 1,19,000. Sorry, 11,90,476. 476 euros. All right. So on this, what will happen? I will get interest. So I'll add interest. What is the interest that I'm getting over there in euro? Let me confirm the number. 11,90,476. They have got 11,86,000 is what they have got. Is that a rounding off difference? 10 lakh dollar divided by 1.5390. $11,86,484. There is some mistake, friends. 1 minute. There is some mistake over here. I need dollar bar euro. So I'll sell dollar. The bank will buy dollar and return sell. So ask dollar bar euro is what I want. That will be ask dollar bar pound into ask pound bar dollar. So ask dollar bar pound is 1 point. It's rounding off, is it? Okay. Let me try doing without rounding off. 1.5390. 260 into 84 lakh 28. Okay. Oh, let me just try it once again without rounding off, friends, for my satisfaction. $11,86,484. Correct. All right. So I'll take the correct number over here. It is 11,86,484. 84 euros. All right. I'll add back interest now. Add interest. How much is the interest in Europe? 3% per annum. This into 3% into 3 divided by 12. 8898. 8898 euro. So you'll get 11,86,484 plus 8898. You get the answer as 11 lakh 95,382. This is the total closing balance in euro. So now what happened? Once I get this, I'll have to convert this into what? I have to convert this into pound again, correct? So once I convert this, I'll give euro, bank will give pound. Again, it will be the ask rate. So 3 months forward ask rate. 1195,382 divided by, because euro, right? Other one is euro per pound. Divided by 3 months forward ask rate is 8290 plus 140 minus 140. 8150 divided by 1.8150. 11,95,382 divided by 1.8150. You will get 6,58,612. 612 pound. Friends, did I do it correctly? I am also getting totally confused now. Yes, the answer is correct. It's correct. Okay. Minus the opportunity cost. Less opportunity cost. How much was our opportunity cost over here? 652,666, correct? 652,666. So once you do this, what is the answer that you get over here? 5946 is going to be your gain, correct? 658,612,6. Okay. 5496. So here 5496. Please write down this, friends. I'll give you some time to absorb this one. This was tricky. Please do it. Going down a little bit. Beautiful question, friends. So here we get 5946. Here we have got 6462 as the gain, and in option 1, let's check how much have we got. 5229. So tell me, friends, which is the best option out of all the three? You investing in New York is better. That is the final answer. But let's see the conclusion over here. Since the out of three options, in case of investment is made in Frankfurt, 4096, 6462. Yes, New York only it's better, but I don't know why they have given a conclusion out of the three options. That's a mistake, friends. Okay, it's supposed to be New York only. Dollar is the best offer. They also have got the same answer, but they have ended up writing the other way around. So just ignore that part. All right. So we are done with New York is better, friends. So we are done with this question also. Shall we go to the final question now? Oof. Ready. Let's do it. Working question number 1A. Working note number 1. Basic data. All right. So here they have told on 1st October 2021, Mr. P enters into a forward contract with an XYZ bank to sell $5 lakh on 31 December at 7.4. However, due to the request of the importer, Mr. P received the amount on 28th November. Mr. P requested the bank to take the delivery on 30th November. The interbank rates are given over here. So let's do one thing. We'll put the spot rate and find out the forward rate first. Particulars, bid rate, ask rate, spot. What is the spot rate? 75.22, 75.27. What is the swap points they have given over here? 10, 15. Ascending or descending? Ascending. Add or subtract? Add. Okay. These are the rates that you are going to get. Once I put the rates, then I'll draw a diagram. What is the first date they have told? 1st October 2021. Okay. On 1st October 2021, this fellow has entered into a forward contract to sell. Exporter means sell 5 lakh at 75.4. Sell $5 lakh at 75.4. Okay, that's the first date. After that, they have told that this is supposed to get due on what date? On 31 December. It's supposed to happen on December 31 was the original due date. All right. Now what is happening? This fellow has got the money on November 30th itself. So that's only 2 months is over. Correct? Today is October 1st. Interbanking rates on 28th November is given as 75.2 to 75.27 and they have given a forward rate. Now tell me friends, how will I cancel my contract on this date? Original contract was sell. So what will I do over here? I will enter into buy. So when I do a buy, will it be a bid rate or the ask rate? At 1 month forward ask rate. Okay. It will be 1 month forward ask rate. That will be 75.42. So once I do this, both of this thing over here will get nullified. Can you put this diagram in your books? Fine, friends. I believe you're all done drawing this diagram. So I'll just put the answer now. Okay. So I'll write down first part, gain or loss on early cancellation. Point number A is going to be what? Current position. That is sell $5 lakh at what price? 75.40. That is 377 lakhs. Point number B is going to be what? Action to cancel. How are you going to cancel the thing? By $5 lakh at what price? 75.42. So you get the answer as 377.10 lakhs. All right. So what is the loss that you make over here? Do you make a loss of 10,000 rupees, friends? Can you write down till here in your books? 10,000 or 1 lakh? 377 lakh 10,000, right? 10,000 only, right? Okay. All right, please write down this. Friends, the answer in MTP is very much different. We'll just do this and then I'll just cross-check. Okay, Padmapriya, please write down the basic data. Give me a moment. I just want to go through the answer that they have given. Spot rate is 75.22, is it? The spot bid rate, right? They have already have a contracted rate over here, correct? And they are not cancelling at the spot rate. They are going to cancel at the 1 month forward rate. What we have taken is correct. Not the mistake there. Just 75.22. Please write down the basic data. In the meanwhile, let me just process what they have done here. Agreed rate of 83.1. Bank will buy. Let's draw a bank diagram also, friends, to understand this better. So you have a customer over here. Assume this is the customer. And this one is going to be your bank. And here you have a London bank. All right. Now here what they're trying to tell you is that initially what is the transaction that you have over here? This fellow is selling at 75.4. What is the bank going to do? Buy at 75.4. Now the bank has to cancel the transaction today. How will the bank cancel the transaction today? It will sell at the spot bid rate, that is 75.22. That is the spot bid rate. So the position gets nullified. Now ideally what happens is he is supposed to come back to the bank after how many days? He was actually supposed to come back on November. But did he come back in November? No. He's supposed to come back on only what date? December. But instead of December, when did he come back? He came back on November and he bought at what price? Bought at 75.42. So what the bank has to do? Bank will have to sell over here at what price? 75.42, correct? So once it sells here at 75.42, but in the US market, the contract is happening only on December. So it will not happen now. In December, what the bank will do is, bank will buy at whatever is the spot rate on that date. That is not given in the question. At the December spot ask rate. So this is not given. Can you draw this diagram also in your books? All right, friends, I believe you're done. I will just now give you the solution as per the MTP. Then we'll cross-check with the study material question to understand whether they are doing it in the same manner there or no. Okay. How they have done it over here is they are saying that because of early cancellation, bank will charge two things. One, bank will charge the swap loss. So here what they are trying to say with the swap loss is that bank has entered into a transaction over here at what price? 75.22. Bank has sold at what price? 75.40 originally. That would have been okay. But now what has happened is over here, bank has sold at 75.42 early. This was supposed to happen after a month, but now it has happened at the original date itself. So what they are trying to tell you is that first, what is the bank's point of view action? Bank has sold at 75.22. Bank has bought at what price? 75.42. So in that case, what is the loss that the bank has made over here? 0.20 rupees per dollar into 5 lakh dollars. Do you get the answer as 1 lakh rupees? So they are saying that bank will charge this 1 lakh from the customer because bank is suffering this loss because of the customer. Okay. Point number 2, they will have interest on outlay of funds. All right. So what they're going to do over here is point number A, they will take the selling rate. Bank is originally selling at what price? Is it selling at 75.22? It is buying from the customer at what price? 75.4. So there is a loss over here. What is the loss that the bank is having? 0.18 into 5 lakh. That will turn out to be how much? Do you get the answer as 90,000 rupees? This loss will get covered up in November, but they will have to pay interest on this for that 1 month early that they have done. What is the interest rate they have told over here? 18%, correct? So interest at 18% for 31 bar 365. So that will be 90,000 into 18% into 31 by 365. You get the interest amount as 1375. So 1 lakh and 1375, when you add up these two, total amount payable to bank, total amount payable will be 1,01,375. So this much money the bank will deduct and only pay the balance money as per this MTP problem. All right. Can you please write down this in your books? So this part, friends, please by heart. It's slightly, not slightly, it is a bit different from the normal convention. And we have a similar question in our material. Let me just cross-check that with this now. Fine, friends. I believe you are all done with this part. Okay, let me just cross-check this, friends, for my satisfaction. We have a similar question in study material with 65.22 as a number, but The answer methodology is slightly different is what I believe. We're talking about Forex. There is a question with 65.22. Yes, this question. The sells at 65.22 here. What are we doing? Selling at 75.22, 75.42. 65.22, 65.42. So they get a loss of 20,000 here. And down 75.2 to 75.4. Okay, exactly the same thing they have done here also. So they get 20,275. Let me just read through this question, friends. Let me quickly just solve this problem so that we are clear with this. It's illustration 4 of your material. I just draw a diagram. Here, a forward contract with BNP to sell at 65.4. In our example, it was sell at 75.4, correct? So I just write down over here, sell at 65.4. They want to cancel on 28th November itself. So it will be 65.27 plus 15. That will be 65.42. You will have a buy at 65.42. So ideally you make a gain 20,000 into 0.02. Oh, okay. All right. So they don't consider this at all. Okay. Fine, friends. Just by heart this one answer. Okay. This answer is the same way they have done in illustration number 4 also. So this happens in case of early cancellation. Okay. So please mark it as this and just by heart this one question because this doesn't make complete sense. It's only from a banker's point of view of what loss they make, they're covering up from you because of early cancellation. So mark this question as important, friends. All right. Yes. All right, friends. So we are done with this question also, and with this, we are done with our MTP session. George, I will do one thing. I'll call you separately. It might get a bit confusing for others also. Otherwise, I'll give you a call. We'll have a discussion on this. Okay? Right. So, friends, I believe we are done with this part. Yes. With this question, shall we now wind up our session, friends? I hope you have understood all the questions that we have done. Wait, even before I pack up, I need to upload these notes, correct? I'll do it right away now. Please stay there. Otherwise, later on, I will forget and you may not get these notes. So please confirm that you're getting the notes right away now. MTP part 1, SFM and written notes. Okay. It's getting saved. Give me one moment. It's done. It's saved. So I'll just go to my website and upload it. You can visit tarunjagdish.com. Click on notes. Inside this, I have MTP series 2 is there. Okay, same way I'll make a new folder now. MTP November 23 series 1 handwritten notes. All right. Okay, so once I come inside this, I'll upload the document here. Done, friends. Please confirm that you can view the document right away now. I believe you can do it. Perfect. All right, friends. Shall we pack up our session with this part now? Okay. So, friends, we have come to the end of our long sessions where we covered mentoring, we did mock test, we did assignments, we did RTP, MTP, we did a one-day marathon, and we also did Super 25. Friends, now as many of you had requested, exam, when is your exam date? Please let me know once again. November 3rd, is it? SFM exam? Or when is your FR exam getting over? So FR exam is getting over on November 1st. Am I right? Correct? So November 1st evening, all right, I will come live around 8:30 p.m. till night 11:30 or 12 o'clock. We will do Forex revision. Are you all okay with that? I'll put that in the WhatsApp group. If students are willing, I will do that, because many students told me that after FR exam, anyways you will be exhausted and tired. So at that point of time, if you get an forex revision that day itself, so the major chunk is over. So from next day you can focus on the other topics. Am I right? But I'm not very sure how one day before the exam are you comfortable attending classes or no. So if you're all sure, I'll put a poll in the WhatsApp group. Please vote for this so that I can understand definitely that you're all much more. It'll be useful for all of you. If it is useful, definitely we will do that. All right. So November 1st will be the day when I'll go live. 8:30 p.m. is okay, or should I do it a little bit early? What time is advisable? Last time I think 7:30 was the time that some students told early. 7:30 or 7 o'clock? 7:38, 7:30. I'll do one thing. I'll start off by 7:30 p.m. All right. Yeah, Padma Priya, when you're traveling back also, you can put your headphones and you can listen to it, right? Or should I make it 8 o'clock so that it can be uniform for all of you? You're driving bike. Let's make it 8 o'clock till 11:30 or 12 o'clock. Okay, 4 hours of marathon session we will do. And by 12, I'll pack up so that you can go and sleep with one major chunk out of your head. All right? All right, friends. So I'll see you on November 1st, 8 o'clock, my final session for this examination. So that this attempt, let's score 70 plus. Thank you so much, friends. Good night. Take care. Good night, friends.